Hi Adriaan, good morning. We have the rand slightly weaker this morning, 7.41, and that was after seeing some strength coming through yesterday. It looks like risk aversion back on the fore, and Greece's debt problem still one of those worries.
Well, that's quite right. We saw an improvement in risk appetite earlier this week after the relapse last week, or the end of last week. But I think what's happened is that concerns about debt issues remain. Obviously, those around Greece is very topical at the moment. Portugal also entering the frame here. But what has also happened yesterday is we had the World Economic Outlook from the IMF, and they specifically highlighted the risks involved in elevated debt in countries like Greece and the like. So the point is, I think we've seen a bit of risk aversion emerge again, and this has pushed the rand a bit weaker. We actually expected it to regain that trading range of 736 to 720, which it didn't. We still think rand bulls could run into that range in the near term, but for now, maybe a sideways movement. What is also interesting from the IMF's World Economic Outlook is the specific reference to potential currency misalignments in the EM space. Now, they had a specific analysis where they showed currency movements on a real effective exchange rate basis over the last year, and there South Africa really stands out, and in the sense that we've appreciated the most on that measure. So this is probably going to continue to fuel arguments from our domestic authorities that the rand is too strong.
Of course, at the same time, we had them upgrading their growth forecast for South Africa to 2.6% for this year, and that was from 1.7% that they previously forecast. This still looking quite conservative, though, slightly higher than the official forecasts from the government and the Reserve Bank, but not quite what the market's looking for, is it?
No, that's quite right. I mean, we're kind of going with the market here, where we think that growth could actually be in excess of the 2.75% approximately that both the IMF and the central bank is looking for. We think GDP could expand by 3% and maybe even top that slightly this year, and then accelerate thereafter. I think it remains a difficult call to make at the beginning of this year. Nevertheless, what we've seen is economic activity indicators increase and rebound nicely at the start of this year, but it's still pockets of strength in the economy, and it's difficult to say, well, this is a sustainable recovery that we're entering. But I do think that their estimates are pretty much on the conservative side, and if anything, we'll have a bit higher growth than they're anticipating.
Of course, it's very light on the data front in South Africa this week. We're getting a whole slew of data coming out next week, and of course that coming ahead of the Reserve Bank's next Monetary Policy Committee meeting, which is in mid-May. What are you expecting out? I think we're getting consumer price index, we're getting credit extension, we're also having trade figures out next week. What are you looking for on that front, and how might that alter the MPC's view on interest rates when it next meets?
Well, this would almost be the last bit of a real data flow before the MPC meeting, so it will be, or potentially be, significant. I mean, like you mentioned, there's inflation and credit numbers. We expect inflation to continue to ease, in other words, targeted inflation to continue to ease from that 5.7% level where it entered the inflation target band. I think we could actually see something as low as 5%. Currently, market expectations is for 5.3%, so we think it could be a bit below that. And then credit numbers also likely to remain very soft, in probably negative territory still. So these measures could suggest that the Reserve Bank could really consider another interest rate cut in next month. What is also interesting is the Governor, Ms. Marcus, will be speaking today, and the title of her speech is "The Future of Monetary Policy in South Africa." Now, you could imply or could read into this.
Okay, well, we seem to be having a problem with the picture coming from Standard Bank there, but thanks very much to Adriaan Dutoit, rate strategist at Standard Bank. Still with us in studio, Donald Reid, Investec Private Clients. Donald, the IMF growth forecast, slightly conservative, 2.6%, and as Adriaan was saying, the market looking for a figure closer to 3%. Of course, we do have the World Cup coming up, and some economists saying we could have 0.5 percentage points added on to growth this year from the World Cup. What's your view on that?
Well, I think, you know, you've really got to question growth numbers on the back of a one-month soccer event that's going to be happening in South Africa. I mean, if we just do back of the matchbox calculations, optimistically we might get 500,000 people in South Africa, and I've heard some people saying that each person might spend as much as 30,000 Rand during their stay. If we reach those levels of numbers, which is again questionable, that'll translate to 15 billion rand coming into South Africa from tourists. Now, in my opinion, any growth story related to the World Cup is unfortunately behind us already. The Gautrain cost more than 20 billion rand, all of the soccer stadiums, etc., etc. 1 month of tourists coming and spending money in South Africa is not going to change the growth outlook that dramatically for South Africa, and it's certainly not going to turn our economy around. Added to that, a 2.5% or 3% growth outlook for South Africa is not actually that great, because that really puts us in line, maybe below what you're expecting from developed markets, let alone emerging markets. So I'm afraid that post the Soccer World Cup and the party's going to be over, people are going to have to turn around and take another look at South Africa and say, well, in actual fact, we're not exactly the same as other emerging markets. This is a country where it's difficult to do business and is not competitive as other emerging markets.
And you don't create jobs with 3% growth, do you?
Well, certainly not. I mean, there was, like I said, there was growth on the back of the build-up to the Soccer World Cup over the last 4 years. The Gautrain, all the construction, but that's finished. All of those projects are done. What do we do now?
Exactly. Well, Donald, the interesting point that you mentioned, that we're not very like the other emerging markets, especially the kind of growth that we've been seeing coming through from the Asian emerging markets. And it's a question I've been posing to many investors out there. Do you think that foreign investors are going to become far more picky in terms of where they look to see growth in terms of emerging markets? I mean, the rand, a lot of people say is going to start weakening towards the end of the year. But what kind of pullback do you expect? Do you think we're going to be seen in a negative light?
Well, if I'm going to put a number on it, I'm of the opinion that we will be through 8 rand to the dollar by the end of the year. And I think post the World Cup, certainly with valuations where they are, again, if we get potential interest rate increases in some developed markets, it is going to result in a pullback out of emerging markets. And I think South Africa will certainly be potentially on the chopping block. At the moment, South Africa is just part of emerging markets. Fund managers go and they say, well, I'm going to put money into emerging markets, and everybody's kind of thrown in a bucket together: Turkey, Poland, Brazil, South Africa, etc. But I just question South Africa is not as competitive as other emerging markets. Our labor laws are very, very strict. It's difficult to do business in this country, whereas, you look at the Asian economies, labor is very cheap. It's a lot easier to get the kind of growth numbers there than what it is in South Africa.
Yes, I heard a report the other day that JP Morgan was lightening its exposure to Brazil and to China and increasing its exposure to South Africa. Does that seem at odds with what other fund managers are doing?
Well, I think if you look at the fund flows, that'll certainly that'll talk to that. But there are concerns around China. Their market is expensive at the moment, and you are starting to see some concerns around property speculation in China. The concern that I would have is, China really is the growth engine of the world, and if fund managers are concerned about China, if they're moving money out of China into South Africa and China does start to come off, it's going to affect sentiment towards emerging markets across the board. I certainly don't see South Africa, by and large, being a large recipient from a disinvestment out of China, where our growth is very much reliant on what happens in China.
So you go from China rather into developed markets?
Well, I think certainly, developed markets from a valuation perspective is looking, they are looking more attractive at the moment, but we're seeing such a differing of information at the moment. You're getting very strong earnings numbers coming out of the States. The economic situation there is looking very, very good, but the European situation is looking dire at the moment. And it concerns me that the market is not taking enough notice of the potential downfall of what's happening in Greece at the moment. If you just look at the Greece situation, where 5 years ago they were able to go and loan money on the international markets at 3% or 4%, now they're having to pay double. But not only are they paying double, their tax revenues are decreasing, which is why they need to go to the IMF for money, because they can't afford to pay these high rates in the market. Now, that's a situation that's very difficult to turn around. And the potential spillover effect into other European economies is quite significant. And, if that does happen, you've got to ask yourself, has growth in the American market, has that got the ability to actually pull a dying Europe along with it?